Think you can trade options with just $1,000? Well, think again. I usually focus on bigger accounts, but in this video, I'm going to focus on showing you guys strategies where you can scale a smaller portfolio using different option strategies that give you a lot of leverage, medium risk, and really high returns. I'm going to be using my notes here, and I'm going to show you how you can basically start building consistent income with a small investment in your portfolio. In this video, I'm going to be using 3 powerful option strategies to teach you how to make money even with a small account. So stick around. I'm going to walk you through step by step on everything that you need to know, including real world examples on how to execute on these strategies. So let's jump into the first one because I respect your time. Let's just get to the point here. Let's talk about put credit spreads. And this is a bullish to neutral strategy. Now, a put credit spread, what it is basically a strategy where you sell one put option and you buy another put option at a lower strike price. So your goal is to stay above the strike price that you sell. Let me give you an example on the screen right now. There is a stock, let's call it XYZ stock, and it's trading at $20 per share. If you sell a $19 put option, and then you buy an $18 put option, they're both expiring in 30 days. And let's say that you collect a premium of 40 cents or $40 total, your maximum loss on this spread would be $60. The spread width is $1, times 100 shares, but you've collected $40 in premium. But I first want to go through the theory so you understand this on a deep level and that you basically master this in a very short amount of time. So look, here's what happens. If the stock stays above 19, both options expire worthless and you get to keep the $40 premium. Now, if the stock drops below 19, but stays above 18, then you have a partial loss. You're going to lose something in between. Okay. Now, in the third scenario, if the stock drops below 18, well, you have a maximum loss of $60. The reason why you only lose $60, you can't lose more, is you're fully protected by the put option that you bought at the 18 strike. So you can only lose money between 19 and 18. So if you're completely wrong, it's not a problem. And if it stays above, well, that's the perfect scenario for you. So why is this so great for small accounts? Well, this actually requires less margin than selling naked options. So this is really good in terms of how much money you put out. I mean, it's only $60. The risk is capped. So you basically get to calculate the exact amount of risk that you have, and you know your risk up front, which is really good. And then the third thing is you can adjust strike prices and premium to fit $1,000 account. If you want to pick a spread that's $500, which is my typical, to be honest, I typically do $500 spreads. That's perfectly fine as well if you have a $10,000 portfolio. This is also really good for large accounts, and using spreads can be a very fun and lucrative activity for bigger accounts. Folks that have $100,000, they can put $5,000 of their portfolio into a spread strategy like the put credit spread. So when would you use this strategy? Well, essentially when you expect a stock or an ETF to stay flat. So if it's moving sideways, then you can easily do a put credit spread strategy. And if it's a high momentum stock, you can also do a put credit spread strategy. Also, when the stock is at a 52-week low. So there's many instances. For example, I cover AMD a lot recently, and it's because AMD has hit a 52-week low. You can absolutely do a put credit spread on AMD. I'll show you that in just a moment. And you can also do a put credit spread on a high quality company like Palantir. Palantir is going up a lot. And let's say you don't have enough money to sell puts on Palantir. Well, you can also replace selling puts with a put credit spread. The tips that I would have for a beginner is to do this on lower volatility stocks, but you can also do this on stocks with high momentum, 52-week low, or sideways action. All right, let's go over the first example right here. So the first example is going to be a put credit spread on Tesla. Now, I want to point out that Tesla has currently pulled back. So Tesla was as high as $478 per share, and now Tesla is under $400 per share. I see a really strong support under $380 per share. So I'm going to show you what a put credit spread looks like. I do have a pretty large position on Tesla, and I'm bullish on Tesla long term. The put credit spread strategy will allow me to collect some income, create some income if Tesla stays above the $380 level. So I'm going to pick an expiration date, and I'm going to pick an expiration date for, say, March expiration. This gives me about 2 months out from expiration, which is a really good time frame for an expiring option. Now I'm going to look at the 380 here. This is going to be a really high return of 38 delta. I'm actually going to show you 2 different examples on Tesla, one that's a little bit more aggressive and one that is a little bit less aggressive. So this one is going to be more aggressive because the delta here is 0.38. So if I sell this option right here, the premium that I collect is going to be about $3,200. Now, to open up a put credit spread, we sell one put option and then we buy another put option to close out that actual spread and to create a $5 gap. I like doing $5 gaps because I think it makes the most sense. However, you can vary this. You can even do a $10 gap. there is a slight difference for sure. The 380 and the 375 is going to be the move that I'm going to make. So right here, you will see that I have opened up a put credit spread, and I have basically sold and collected $3,200 and $3,230. But I am buying a 375 put, and I'm spending about $30.15. So the put credit spread here is going to be $215 collected, and I am risking, typically it's a $5 gap, but because I'm collecting about $200, it's going to be less than $300 of capital that I'm putting to risk here. So the return potential is actually very huge. It's almost around 40-50% return in 2 months. Now this would be riskier, and that's why the return is so high. 40-50% return in 2 months is a lot. Now, if I go down, you'll actually notice that based on the Tesla chart, I do think we have very strong support at 380. But let's say that we want to hit, ultra strong support back when, back last year when Tesla was, under $350 per share. So I can scroll down here and show you that even the 350 strike here is going to have a much lower delta. It's also going to have a much lower premium. So the lower that you go, the lower the premium becomes, but the safer this option strategy becomes because it's further out of the money. So if you wanted to go very, very conservative, then right here you can see that there's a 330 strike price. The delta is 0.2. So there's a 20% chance that this will happen and an 80% chance that this won't happen. So if I go ahead and sell the 330 and then I go ahead and buy the 325, you will now see that the total credit that I'm getting is going to only be $100 roughly, and I'm risking, roughly $400. So 100 is what I'm collecting in premium, 400 is what I'm risking. That's a 25% return in 2 months. And this is going to be a lot safer because, as you can see here, to actually lose on this position, Tesla would actually have to fall from, $390 or so per share as I'm making this video. If you're watching this in the future, it's the same logic and thought processes. So Tesla would have to fall all the way to about $328 or $329 roughly, because it's the strike price of 330 minus the premium that you collect. So it's about 100 or about $1. So 330 minus $1 is 329. So that would be your break-even price, and that would actually mean that Tesla would have to fall a lot for you to lose on this strategy. All right, let's jump into the second strategy that you can really scale up your portfolio. And even starting with $1,000, you can scale it up to $5,000, $10,000. Obviously, ideally, you have a 50K portfolio and then you're scaling up a bigger portfolio. But this strategy is fantastic for a small portfolio or a big portfolio looking to use a portion of their money on a bit of a riskier strategy that is really high return, like extremely high return. I'm telling you, like this strategy. Next one is iron condors. So iron condors, this is for a range-bound market or a range-bound stock, a stock that isn't really moving up or down too much, that's really moving sideways. So what is an iron condor? Well, this is a strategy that combines a put credit spread, which you just saw, and a call credit spread. So you're selling options on both sides, you're selling puts and you're selling spreads on both sides, and this is an iron condor. An iron condor benefits when the stock moves sideways, and your goal is for the stock to remain between the strike prices of the iron condor. So I'm going to show you an example, but I'm going to first of all give you the theory behind how this works and why this is so good. So let's say we pick a $30 stock and then we end up selling a put credit spreads. So we sell a put at 28 and then we buy a put at 27. And then we decide to do the same thing on the call side. We sell a 32 call and then we buy a 33 call. So we have a put credit spread at 28, 27, and then we have a call credit spread at 32, 33, right? So we're $2 down and we're also $2 up. So we're doing put credit spreads on both sides. And let's say both are expiring in 30 days. So we pick the same expiration. That's what an iron condor is. It's a call credit spread, a put credit spread, and same expiration. Okay, so let's say the premium that we collect is 50 cents. So your maximum loss here is actually pretty insane. We only have a $1 gap, right? We have 28, 27, that's $1. And then 32, 33, that's also $1. But check it out. An iron condor, it can't be both down and up at the same time. And for that reason, we're only going to have $100 worth of risk, even though we have like two option positions, both 100 each. It's actually the total position together is only 100 total. So that's a huge benefit. You get to open two positions for the same price as one, right? So if we collect $50 here and we're only risking $100 worth of capital, then our risk is really only $50, okay? And what will happen is if the stock stays between 28 and 32, that's what you want to happen, as long as it doesn't go below 28, okay? And if it doesn't go above 32, your options are going to expire worthless, and the $50 that you collected on 100 is yours. So you get a 50% return. I mean, you can make 50% in like a week, 2 weeks. If you can do that, obviously it's like a few times in a row, you like have crazy returns, right? I mean, it's big returns. However, you got to be careful with risk management, and you also have to understand position sizing, and then you also have to understand technical analysis. All that stuff I can cover later. But look, why would you want to do this? Well, you have very little capital that you put at risk, right? So you're putting in a very small amount of capital, which is very risk friendly. So this is a fantastic strategy for beginners because you know exactly what you're risking, and it's a very small amount. So you can start with like bare minimum nothing. Now, you can also do this on ETFs like SPY. You can do this on ETFs like QQQ. And those are also really good because they're very stable, but the market isn't stupid. And because they're stable, they also have very low volatility. So this strategy would be even money. What I mean by even money is it would be equally good on SPY and QQQ, although it would be a lower return, it would be a lower risk, as it would be to have a high return and higher risk on something like AMD. Okay, the Iron Condor strategy, I'm going to show you NVIDIA. NVIDIA is a really interesting play for the Iron Condor strategy because NVIDIA has actually been moving sideways for a very long time. You can see here how in mid-January 2025, NVIDIA is around $135 per share, but it's actually literally been the same price even in early October of 2024. So it's been the same price for many, many months, and NVIDIA hasn't really found any strong momentum on the upside or the downside. So the valuation here looks very fair for NVIDIA. And because it's moving sideways, this would be a perfect candidate for an Iron Condor strategy. The Iron Condor strategy is very strong. It's very powerful because it sells both calls and puts. You're collecting a lot of income. So you first want to start this off by selling a put option, very similar to our first example on Tesla, how we did a put credit spread. So if I also go for March expiration here, which is going to be about 2 months out from the time I'm making this video, you will notice that NVIDIA, if we sell a put option, what we want to do, if I go back to NVIDIA here, I'll actually show you an indicator that I use for using the Iron Condor strategy. So if I go to the charting tool here on NVIDIA using Yahoo Finance, you can use any other platform as well for analyzing. And you go to indicators, and I go to Bollinger Band. I'm going to be using the traditional 20 and 2 Bollinger Band. So now you'll notice that I have created a Bollinger Band here, which is 20 and 2, and NVIDIA is actually right at the center of the Bollinger Band. On the bottom of the Bollinger Band, we're just under 130, and at the top of the Bollinger Band, we're just under 150. So roughly the 130 area, because I'm pretty bullish on NVIDIA in the long term, I'm going to go a little bit higher for the 130. Now, for the top Bollinger Band, since I'm a little bit bullish and that's my bias, I'm going to actually go for 150. So the strike prices that I'm going to pick for the Iron Condor are going to be 130 and 150. And that's basically how I'm picking it. That's a short way of doing it. So now what we are going to do is we're going to sell a put option at 130. So I'm going to sell this 130 put. It's going to have a bit higher delta, which is okay because this is going to be a very high income strategy. And you won't be able to win it all the time, but it'll be profitable as long as it stays between the strike prices. And even if it goes slightly beyond the strike prices, the way to manage this position is to just close it if there's any strong momentum on either side of the equation. More often than not, since selling options is a profitable endeavor long-term, this is still going to be a profitable strategy. Even if it goes into the money, you may still be able to close out the option for a profit. Let me show you the example. So I'm going to sell the 130 and I'm going to buy the 125, again, going for a $5 gap. Now this is going to be a put credit spread, 130, 125, put credit spread. The total credit here is $1.90. Now what I'm going to do is I'm also going to sell a call option, and that's how the Iron Condor is going to work. I'm going to sell a call option and buy another call option. So I'm going to sell a call option at 150 because that's where I said that I see a little bit of resistance here for the next couple of months, since this is a range bound stock at the time that I'm looking at the chart. So if I sell call and then I go ahead and buy another call, I'm also going to do a $5 gap here. So now you will notice that the total credit I'm collecting is $330. So my max profit is around $330. Robinhood's putting it at 343 roughly, right? The market isn't open at the moment. And the max loss is 150. Okay, so let's just call it 350, 150. So the maximum profit is huge. It's way more than what you're risking. And as long as NVIDIA stays between this range, you're going to be, very profitable. Now, even if 1 or 2 days goes by, this option will start to decay. And because you've collected 350,
per day, on a 60-day period, you might not make that much at first, but a couple weeks go by, you might see you have a profit of $30, $40, $50, and so on. And then once you get into the last month, this option is going to decay very heavily as long as NVIDIA stays between this range. If it stays between this range, the option's decay is your profit.
All right, guys, I hope that you enjoyed that example. So let's go into the third strategy. This strategy is absolutely the most powerful strategy because this is actually a buying strategy. This is a directional strategy. It's the debit spread. It's the call debit spread. So this does give you a directional move. You're looking for a directional move on the upside. And this is low cost, but you do need the stock to have a move. So this would be a perfect strategy. Like I've used this on Tesla, and on Tesla, I have absolutely printed money. Like I've printed, had a money printer. And back in actually 2021, I grew my account from 100K to 700K, and that was through Tesla. And I've done a lot of debit spreads. Debit spreads are fantastic because you can double your money, you can triple your money, you can do some really big things. I'll show you an example in just a moment. Let's cover the same format and stay organized here. And let's cover what a debit spread is. First of all, you buy a call option and then you sell a call option that it's a higher strike. So for example, let's say the stock is $15 and you think it's going to explode. So, this could be something like SoFi. Okay. So looking at SoFi right now, it's around $15. Let's say that we think the stock can be a lot higher. And we say to ourselves, well, why would we pay $15 per share when we can just buy a call option? Okay. So let's say that call options are going for 60 cents. All right. So we buy a call option for 60 cents. Now we say to ourselves that we think the stock will go to $17 really quick. We think that'll happen very fast. So what you would do here is that you would buy a 16 call option, and then you can also sell a 17 call option. Say the 16 call option is worth, 60 cents, and the $17 call option is worth 30 cents. They're expiring in 30 days. So here you are paying 60 cents, but then you subsidize your cost and reduce your cost by 30 cents because you sell another option, and you basically cut your premium in half. You pay 60, but then you collect 30. So your net cost is only 30. And essentially what you have here is you have a maximum profit potential of 70 cents. Because if the stock goes up to $17, you have a total gain of $1, right? You have a total gain of $1. And why is it $1? Well, you don't get the benefit right away from $15. You only start getting benefit from 16 to 17. So your 16 call option goes into the money, and at a maximum, you can make money up to 17 because you sold a 17 call option. So from 16 to 17 is $1, and your net cost was 30 cents. So essentially you can turn 30 cents into $1. I mean, that's over 3x return. So in this example, you have a maximum profit of $70, or you turn $30 into $100. You can at most lose $30. And there is a little bit of a different scenario. If the stock ends up being between $16 and $17, you will have a partial profit. So let's say that the stock goes up to, $16.50. Then you have 50 cents as your gain. You spent 30. So, you would have a $20 gain from a $30 investment. So you would turn $30 into $50 if it were to end at hypothetically $16.50, right? Somewhere in between.
Let's talk about debit spreads and an example using SoFi. So SoFi is a stock that has had tremendous momentum. And because its market cap is very low, it's around $15 billion. I am bullish on SoFi in the long term. And I think using a portion of your money is very smart. So understanding that SoFi has positive momentum, it's recently stalled with a little bit of a pullback. However, let's say that the trajectory continues. And in this example, let's say that we believe that SoFi is going to be $17.50 stock in the next, we can take out even a longer point of view and say in the next 3 to 6 months rather than just 2 months. So here's what a position would look like on SoFi for a debit spread or a call debit spread. We also call this a bull call spread. Okay, they're the same thing, just using different terminology here. All right, so I would go to trade SoFi options. The first thing that we're going to do is we're going to change the expiration date to something a little bit further in terms of, expiration. So let's say that we go for June 20 expiration. That's very, very long term. It's not a leap option, but this is a longer term play, about 5 months to expiration. So again, we think that in this example, that SoFi will be $17.50. So there's a few different things that you can do here. First thing that you can do is you can buy the 15 call option right here, and you'll see that the delta is 0.55. So there is a bias in the market that SoFi will rise. You can even see that by the delta. And out of the money option right here has over 50% delta, or over 0.5 delta, which means that the market is bullish. There's very high open interest and very high implied volatility. Now this option is expensive, okay? So I said that we think it's going to be $17.50 as our estimated price target in the next, 3 to 6 months. However, we don't really get much profit if we were just to buy a call option, which is okay because we're doing a call debit spread. So if I go to sell call option and I end up selling the 17, actually let's go for 18 because we think it's going to be 17 and a half. So 17 won't fully capture all the upside, but 18 will. So now if I do 18, you'll see the total cost is only 90. Okay, it's only 90. And now our break-even price is nowhere near the 1730. Because we're collecting income from selling the 18 call option, now our break-even is just only 1586. So if SoFi, if the stock goes up to 1750, okay, right around this area, you can see how we have $163 worth of profit. And if the total cost is 90, we're going to see a very big return on very little amount of capital. If SoFi reaches the full amount, which is $18, we can't make more than $18 per share, we're going to see a full benefit from 18 and from 18 and 15, the difference there is $3. So we can essentially, our total cost here is 90 and our total max gain is going to be that total $3. So we can turn $90 into $300 in this example.
This is a fantastic strategy. This is the best strategy I've ever used in my portfolio. And I've had huge growth. It's obviously a little bit higher risk. And I do prefer to sell options. And you guys already know that I do put credit spreads for like 5% of my portfolio, as I mentioned. I think when it comes to debit spreads, you can also do 5% of your portfolio. And this strategy obviously takes up a small part of the overall larger account strategy that I typically teach on this channel. This strategy of the debit spreads is super powerful. I would say that you want to do it on high momentum stocks. This would still be your Palantirs. It would be your Tesla, your Nvidia, all the stocks that I've recommended on this channel. And you guys saw that I put $1 million into Tesla recently and it turned into $1.5 million. I bought at 2 different price points. Amazing strategy. And this is a strategy that I would use to grow a smaller portfolio. Now that you guys have seen my 3 powerful strategies to scale $1,000, if you want to continue your learning and understand all the fundamentals of option trading, then you can watch my 4-hour free masterclass on option trading for beginners. I'm going to put up on the screen right now for you to watch.